For the liquidity ratio, it's simply talking about what is liquid itself. Liquid is how easy it becomes, the ease at which resources can be turned to cash. That is liquidity. Do you get what I mean by liquidity?
Yeah.
The ease at which resources
The what, mister?
can be
The
turned
is.
to cash. How easy it is
Easy.
for all the resources. These are resources. How can I quickly sell it to make money? That is liquidity. How liquid is it or not? That is liquidity. So when we are measuring liquidity ratio,
Depends on the time, so.
yeah, sometimes it depends on time. It depends on time. It depends on a lot of things. But the point is, a business has to be liquid because every point in time we need to spend. A business has to be what? Liquid, because at every point in time we need cash. Because cash is used for day-to-day running of the business. So a business that doesn't have a cash flow that is positive might lose out or close down. Because you need cash to pay your suppliers, you need cash to pay your employees, you need cash for your rent, you need cash for a lot of things. So it means
But those monthly costs, not day to day.
day-to-day, they are day-to-day running expenses.
Okay.
This company runs expenses day-to-day. It needs to fuel its bosses, yes or no? Maybe there's no light, it needs to fuel its plants. So they are day-to-day running, they need to buy markers. Yes or no? These are day-to-day running of the business. So cash is needed at any point in time. So how liquid the business is what we need to talk about. So we can measure, there's one called liquidity ratio. So this implies the measurement of the availability of cash in the business. The measurement of the availability of cash in our business. That is liquidity ratio. So we have two. We have the current ratio and the asset test ratio. For current ratio, we know for current ratio, we have the current assets and the current liabilities. So the measurement of the current assets over the current liabilities is our current ratio. So what are current assets? These are assets that can easily be turned to cash. Like stocks, inventory, cash at bank, cash at hand. These are our current assets. Then we have our current liabilities. These are the debts to the third party, like overdraft, bank overdraft, like your trade payables. These are current liabilities. These liabilities we have, yes. For current liabilities, these are debts that we have to pay back within a short period of time. Mostly 6 months we have to pay back, or a year. Within 6 to 1 year we have to pay them back. So they are short term, like a bank overdraft. An overdraft is the amount of money you are able to withdraw. An overdraft is a credit facility that allows you to withdraw more than your available balance. So in the bank account, in your bank, maybe you have $50 in your bank account, but you need $55. So if the bank allows you to get $55, the $5 is an overdraft, but it's considered as a current liability. So if you want to measure how liquid we are within the short period of time, we use current ratio. So current ratio is current assets divided by current liabilities. So the total of your current assets divided by the total of your current liabilities gives you your current ratio. Do you get that? These items, you find them in your financial statement, in your statement of financial position, which is your balance sheet. The second one is the asset test ratio. Why do we call it asset test ratio? We call it asset test ratio because it does not talk about inventory. We have to take stocks away from it. So that means it is still more, it's more of things that becomes difficult to get when it comes to cash. So stocks are not expected to be sold immediately. Sometimes it takes a while before we sell our inventories. Yes, do you get what I'm talking about?
Yeah.
Stocks are what the business sells. The product, yes. So it's not expected that you sell them at a go. It might take time, yes or no?
Yeah.
So when you are calculating your asset test ratio, you have to take the value of inventory away from the current ratio. So that's why asset test ratio is current assets minus the stocks of the business divided by current liabilities. So you still need your current ratio, but the difference between it is that you have to take away stocks because stocks take time before it's being sold.
Yes.
Do you understand liquidity ratio?
Yeah.
For liquidity ratio, we have asset test ratio and current ratio. For asset test ratio, is current asset minus inventory divided by current liabilities. For current ratio, it is current asset divided by current liability. That's about liquidity. Then we have the profitability ratio, which is gross profit margin, which is gross profit divided by revenue multiplied by 100, and our net profit margin, which is net profit before tax divided by revenue multiplied by 100. Any question?
No.
No.
Thank you.